According to research, the majority of today's millionaires weren't born into wealth. WealthX published a study in 2019, finding that around 68% of those with a net worth of $30 million or more made it themselves. Among this group of 68% is one of the most famous and richest people in the world. He is technically a billionaire and not a millionaire. The person I'm talking about is none other than Warren Buffett himself. Hello everyone, and welcome back to our channel. Buffett is called the Oracle of Omaha and is a self-made billionaire. He didn't inherit his money or portfolio, but rather he started from scratch and worked his way up. Over the decades of his life, he transformed nothing into billions. But how did Buffett manage to do it? The secret is that he understands what most people don't and adheres to a few key principles you can apply in your daily life. So keep on watching to learn about these 7 rules from Warren Buffett. Number 1. Surround yourself with people who live and work with integrity. According to Buffett, you should never work with someone who lacks integrity, no matter how smart they may be. As he puts it, you're looking for 3 things, generally, in a person: intelligence, energy, and integrity. And if they don't have that last one, don't even bother with the first 2. When you choose to be around people with integrity, you can always trust their actions, and you don't have to worry whether they are hiding anything from anyone. They fulfill their promises and commitments, follow through on their words, and set a good example for others. This is the kind of person you'd like to be around 10 times over. Number 2. Seize every opportunity. If Buffett's success was due to anything, it would be that he is brave when others are afraid. This means that even when the rest of the investing world is fleeing to the sidelines, you would be taking that chance on a stock. While investors panicked over the markets and banks were reeling from losses on mortgage-backed securities during the 2008 to 2009 financial crisis, Berkshire jumped in with a $5 billion deal to back Goldman Sachs. As part of the deal, Berkshire was entitled to high-yielding preferred stock and the opportunity to buy more common stocks later on, which it did, netting billions when Goldman and the rest of the financial sector recovered. A similar deal was struck by Buffett in 2011 to assist Bank of America as it was battling lawsuits stemming from the mortgage bond crisis. By 2017, Berkshire had exchanged its preferred stock for common stock and had continued to increase its stake in the bank, collecting dividends and capital gains worth billions of dollars over the years. Number 3. Don't go along with the crowd. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. The Bank of America reported in April last year that a staggering $576 billion went into stock-based funds from November 2020 to March 2021, vastly outpacing the combined $452 billion inflows from the previous 12 years. Whether you are new to investing or have been doing it for years, going against the grain is often the wisest course of action. Blindly following the crowd can often lead to disastrous results, as the meme stock fiascos of late have shown. Rather than focusing on what's popular, prioritize safety and stability. For example, the Walt Disney Company, Caterpillar, and Intel are 3 blue-chip companies that have underperformed in recent months. If you're a bargain hunter, you can even buy them with your digital nickels and dimes. Number 4. Invest in what you know and nothing more. A simple way to make an avoidable mistake is to get involved in too complex investments. Most of us have worked in only a few industries throughout our careers. It's likely that we have a fairly good grasp of how these markets work and which companies are the best in the field. Despite this, the vast majority of publicly traded companies engage in industries we may not have direct experience with. Warren Buffett says, "Never invest in a business you cannot understand." Investing in these areas of the market is a no-no, but we should proceed with caution. For the most part, the vast majority of companies operate businesses that are too difficult to comprehend. Attempting to predict the success of a drug pipeline for a biotechnology company, foreseeing teen apparel's next major fashion trend, or identifying a semiconductor's next technological breakthrough is extremely difficult. In various markets, complex issues such as these materially affect earnings generated by many companies, but are arguably unpredictable. In the end, there aren't too many fish in the sea to waste time studying a company or industry that is too difficult to comprehend. It is for this reason that Warren Buffett has historically avoided investing in the technology sector. If you cannot grasp the way a company makes money as well as the drivers that impact its industry within 10 minutes, move on to the next one. In the words of Peter Lynch, never invest in an idea you cannot illustrate with a crayon. By staying within our circle of competence and picking up a Crayola, we can avoid many mistakes. Number 5. Keep your eyes on the long term, even if you have very little to invest. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. No one makes fun turns of phrases like that besides the Nebraska native. But underneath the quip, Buffett has an important point to make. Time is the most powerful tool in investing. Researchers have found that investors are becoming more impatient, zigzagging in and out of stocks to try and predict the market's future direction. But rather than focusing on short-term gains, think long-term. Number 6. Do not sell due to price fluctuations. Investing is like riding a roller coaster. The experience is filled with ups and downs, and no one can say for sure when or for how long those moves will take place. After investing long enough, you will discover that your portfolio will produce nothing but losses for weeks, months, or even years at a time. But as Buffett explains in the quote, the true investor welcomes volatility. A wildly fluctuating market means irrationally low prices will periodically be attached to solid businesses. Those periods of decline offer tremendous opportunities to grab high-quality stocks at bargain prices. Investors who purchased stocks during the height of the COVID pandemic have reaped handsome profits. Unfortunately, those who sold out to move their money to the sidelines probably regret doing so. Understanding that volatility is the rule rather than the exception can actually help you take advantage of prolonged dips and swings. Number 7. Pay attention to quality and value. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. There's no doubt that frugality runs in Buffett's blood. Despite having a net worth of over $100 billion, he still prefers McDonald's and has a membership card that grants him free breakfast at the fast food restaurant, something he reportedly avails of often. Everyone loves a good deal, right? Buffett is equally adamant about finding good bargains in stocks, especially high-quality companies. Even with a $140 billion war chest of cash, Buffett takes his time when it comes to investing Berkshire Hathaway's capital. Instead, he stays patient and only invests in good companies when they are on sale. A few of Buffett's famous investments include, again, purchasing Bank of America during the 2008 mortgage crisis and Coca-Cola in 1988 when the company was struggling. Make a watch list of reputable companies you'd like to invest in and then wait for an opportunity to snap them up at a discount. Where do we go from here? It's not necessary to be a billionaire like Buffett to make these investment lessons work for you. And you don't have to limit yourself to just stocks. You can, for example, lock in steady and consistent rental income streams by investing in premium real estate properties, from commercial developments in Los Angeles to residential buildings in New York. With this investment, you'll have exposure to high-end properties that big-time real estate investors typically have access to, and you will receive regular dividends in the form of quarterly distributions. Investment success is within anyone's reach with enough time and commitment to Buffett's principles. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please do remember to hit that like button and subscribe to our channel. And on your way out, please do remember to click on that bell icon too, so you can remain updated about all of our future videos. We'll see you next time.